Welcome to determining filing status of your client. Screen 1 of Drake, which is the name and address, general information, demographics screen. The very first field you come to is your filing status. So right away you need to determine what is the filing status of the client. Either if they're a new client or a returning client, there'll be a filing status selected, but you need to determine if it's still correct for the current year. So I'm going to go ahead and explain what the filing statuses are and what's the importance of a filing status and what it is. So I'm going to scroll down on the page here. So there are 5 different filing statuses. Single, married filing joint, married filing separate, head of household, and qualifying widower. So a filing status is just basically what you were considered during that tax year. And I'm going to explain which each one of these 5 are. First, I want to show you what the importance of a filing status is. And if you recall the very first video, way up here to the Quick Finder front cover, we have what we call standard deductions. And if you notice here, married filing MFJ means married filing joint or qualifying widower. We have single, head of household, married filing. So this is a dollar amount we can subtract from our income to lower our taxes. Either give us a bigger refund or we pay less in taxes. But it's based on your filing status. So that's one reason we want to pick the right filing status. Over here at the tax bracket, based on your filing status and your income, it'll determine how much taxes you're going to pay. And lastly, as we talked about phase outs, again, it's based on how much money you made and what your filing status is. So filing status is very important to determine what kind of taxes you're going to end up paying. Whether you're going to get a refund or you're going to end up paying taxes. Let me get back to our screen. So that's the importance of filing status. Now we have to determine what is our filing status. So first, single. And if you look here in parentheses, 6,300, that's that standard deduction I just pointed out. So I can subtract, if I qualify as single and say I made $20,000, I can subtract $6,300 from that and then just pay taxes on the difference. So the government is kind of telling you that they know it takes a certain dollar amount to survive, buy food, shelter, and everything. So they're not going to tax all of your money. They tax a lot of your money, but not all of it. And so this would be like tax-free money that you can subtract from what the money you've earned. So single. So do I qualify for single? It's pretty straightforward. I'm either not married, divorced, or legally separated, or I'm a widow, so my spouse died, and in the following years I have no children that I'm supporting. So typically it's going to be they're divorced, or they never were married, or they're not married anymore. Obviously, never married, I mean they never got married, so they couldn't get divorced. So that's pretty straightforward. We see a lot of single filers. Next, we have married filing joint. That just means if they're currently married, and it's married based on the last day of the year. So if they were single all year long and they got married on December 31st, they are considered married the entire year. You don't prorate it or anything like that if you choose to get married. A lot of people think, I got married in November, so this year I get to decide whether I want to do single or married. That's not how it works. If you're married at the end of the year, December 31st, you're considered married the entire year. You don't have that option of choosing. Sometimes people get confused with single and married filing separate, which we're going to talk about next. So married filing joint, even if they're living, obviously if they're living together, they're going to joint return typically. If they're not living together, they still are required to do married filing joint or married filing separate, so we'll talk about it in a second. If you look here, the standard deduction, $12,600, it's double what it is for single, which makes sense because there's going to be 2 of you. And it can be same-sex marriages. That was passed last year, I believe. So federal purposes, you can have same-sex marriages for married filing joint. That's not a problem. Next, we have married filing separate, and that's just going to be one person filing So if you have a married couple, just one spouse is actually filing the tax return, the other spouse has filed their own. So two separate tax returns, so which makes that standard deduction of $6,300. So it's half of, and it's the same as what the single person is. So married filing separate, so it's a married couple, and they just choose to file two separate tax returns. Typically, this is the worst way you can file. So the only reason they typically want to do this is if, one, they're not living together and they want nothing to do with each other, so they're going to file separate returns because both parties have to sign a tax return. So if they can't find the other party, obviously you can't file a joint tax return. Second reason might be is that one spouse, either they're not getting along, that could be two, and they could be living together, or one spouse might be doing something, I don't know, maybe illegally, and the other spouse doesn't want to sign that tax return, thinking that it may come back on them, years down the road, so they don't want any part of that if someone's doing something, suspicious. So that would be a reason they do a married filing separate return. Or in our case, we see that sometimes where one spouse, typically the husband, might owe money for back taxes or child support, and so when they file a joint return and they do a refund, the IRS would take their whole refund to pay the debt of that spouse, the husband. So the wife might say, I don't want my refund taken. I'm going to file separately, and that way at least I'll get my portion of it. His refund, he can file his own return and let them take the refund. So that might be, so there are reasons why you might do married filing separate, but typically we see in our office a married filing joint return because in the scenario I just talked about, there might be a better way to do it than married filing separate, and it's called an injured spouse form, which we'll talk about later in this chapter. So we got single, married filing joint, married filing separate. I'm going to skip head of household just for a second because it's the most complicated of the filing statuses. Go down to number 5, qualifying widower. So qualifying widower, what that means is your spouse died, so they were filing joint return. Your spouse dies. You still typically have children living with you. So the very first year when that spouse died, say the spouse died in 2016, then they can still file a joint return in 2016, even though that spouse isn't there to sign. When they file, the other spouse would file and sign as surviving spouse. First year it's joint. Then the next 2 years, as long as there's some dependent children living with that widow, they can file as filing status qualifying widower for the next 2 years. Then after into the third year, they're either going to file as single or head of household, which we'll talk about in a second. So the benefits of qualifying widowers, they get the same filing. It's basically the same standard deduction, same tax bracket as a married filing joint couple. So the government's allowing them basically to file joint for the first year the spouse dies, and then the next 2 years, as long as they have dependent children living with them. But the filing status would just be qualifying widower, because to be joint, you actually have to be legally married to another person. You'd have 2 people on the tax return, whereas a qualifying widower, you're just going to have the one person, but then you'd have at least one dependent child, which we're going to talk about later regarding dependent children. So going out back to 4, head of household, that's the trickiest. If you look here, the standard deduction is $9,300, which isn't bad. It's just under married filing joint and qualifying widower, and it's larger than single. So it's pretty good deduction you get to take. And to meet head of household, the taxpayer is not married or considered unmarried, which we'll talk about in a minute what considered unmarried means. And typically it's someone, the normal scenario is the person's not married, okay, and they're paying all the bills of the house, either renting an apartment or they own a house, so they're paying all the bills, and they have a child, a dependent child, a niece or nephew living with them, so they're supporting that child too. So they're head of household. When you think about that, it means like you're taking care of the household, but you have to be doing it for a dependent child living with you, so you're supporting a child too. This one doesn't have to be a child, but I'm trying to paint you a picture of what the typical scenario is. So you might get sometimes a single person comes in and said, well, I'm head of household because I'm paying all the bills. And yes, you are paying all the bills. However, the tax definition of head of household is you pay all the bills, or at least pay half the bills, and you have to have a dependent child living with you, so you're supporting that child too. So that's the tax definition of head of household. So, okay, let's get back here to, again, explain the tax definition of head of household. So not married, pay more than half the cost of keeping up the home. So you don't have to pay the full cost, just more than half the cost. And the home was the principal residence for more than half of the year of a qualifying child, usually a dependent or qualifying relative. So at this point, when I say qualifying child, qualifying relative, I just want you to think, because we haven't got into those definitions yet, that's later in the chapter, but it's basically like, if you've heard the term dependent child, it's kind of like you're just supporting typically somebody in your household like that's related to like a child. Okay, so if you meet all those qualifications, you can file head of household. So now getting back to number A, considered unmarried, what does that mean? So this would mean the person is actually married, all right? And so if I go back to number 2, well, if they're married, they have to do married living together. I'm sorry, they have to do married filing joint or married filing separate. Those are your only 2 options if you're married. You know, that's what you just said. And that's true. However, there's an exception, and in the tax code, there's always a lot of exceptions. This is one exception. So if you're married to somebody, but you haven't lived with that person for the last 6 months of the year, and you have a dependent child living with you, then you're considered unmarried for tax purposes, and you can file head of household filing status. So let me repeat that. So I'm married, okay, but I'm not living with my spouse for the last 6 months of the year, and typically that means they're probably going to get a divorce or stay separated, and I have to be paying, you know, half the upkeep of the house for the whole year, and I have to be paying half the support and half the support for a child living with me too. So if I meet those requirements, then I will be considered head of household filing status. And when we talk about some more of the credits that people are entitled to, sometimes they can't get those credits if they do a married filing separate return, but they are eligible for them if they do a head of household. So head of household filing status is very important. You need to understand it because we do a lot of tax returns with head of household filing status. So if I want to rank these in order, you know, married filing joint would be number 1, just because you're able to get a larger standard deduction and your tax bracket is better, and the phase outs are better too. Qualifying widower, right there with them, so 1 and 2 because they're exactly the same. Then you go to head of household, then we go to single, and then married filing separate is typically the worst way to file. But there may be reasons why you want to do married filing separate. And occasionally, I want to point one thing out. Sometimes, it's rare, but sometimes we can do a tax return, and in Drake, we can actually hit a button and split it and do married filing separate, and it'll tell us that overall, they're going to get a larger refund to do married filing separate than they are to do married filing joint. So it's rare. It's typically the client's earning more money, so they're earning typically $150,000, $180,000. They're both working. They both have deductions, and sometimes it actually is better. But typically, in the January, February time frame, you're not going to see that type of client. Your client's going to be more of a head of household client, typically single, and they are paying more than half the support of an individual, a dependent, and they usually can file head of household filing status. Thank you.